This is a breaking update on the silver market, and what's happening right now is not being priced in yet. Over the last 24 to 48 hours, something important has quietly shifted beneath the surface of silver trading. Not the price you see on your screen, not the daily candles most people obsess over. Liquidity. And when liquidity tightens, price does not move slowly. It does not move politely. It moves violently, often without warning, and usually when the largest number of participants are least prepared. Tonight, I'm going to walk you through exactly what just changed in the silver market, where stress is building right now, and why this phase is far more dangerous than a simple price drop. This is not about hype. It's not about fear. It's about understanding how markets actually break. Stay with me, because this is the part of the silver market most investors don't understand until it's too late, and by then, the damage is already done. To understand what's happening now, we need to start by clearing up one of the most misunderstood concepts in all of financial markets: liquidity tightening. Liquidity tightening does not mean silver is running out tomorrow. It does not mean vaults are suddenly empty overnight. It does not mean some dramatic apocalyptic event has already occurred. Liquidity tightening means something more subtle and far more dangerous. It means there is less silver available at the margin, exactly where trades are settled, hedges are rolled, and obligations must be met. That margin is the danger zone. It's where stress first shows up. When liquidity tightens, spreads begin to widen, delivery timelines stretch, paper claims start multiplying faster than physical availability can comfortably support. This is where markets actually break, not with flashy headlines, but with friction. Friction between buyers and sellers, friction between paper and physical, friction between expectations and reality. And right now, that friction is increasing. What's critical to understand is that liquidity problems rarely announce themselves loudly. They don't trend on social media. They don't come with sirens. They show up quietly in how markets behave, in how easily trades get filled, in how quickly price reacts to relatively small amounts of buying or selling, in how willing or unwilling large players are to step in and provide stability. And over the past several sessions, silver has begun to show multiple signs that this stability is weakening. Here's the key update. In recent trading sessions, we've seen reduced depth in silver futures markets. That means fewer resting orders sitting in the market to absorb pressure. At the same time, we've seen faster drawdowns when demand spikes, even modest ones. Price is moving further, faster, on less volume. And perhaps most importantly, we're seeing hesitation from large liquidity providers, the institutions that normally smooth out volatility by stepping in when things get uneven. That last point matters more than anything else. When big players step back, it sends a very clear message. It says risk is rising faster than they're comfortable with. This isn't panic selling. This isn't some emotional response. This is controlled withdrawal. It's the quiet decision to reduce exposure, widen spreads, and let the market fend for itself a little more than usual. Historically, this phase does not happen after volatility explodes. It happens before. And when this phase appears, it often comes ahead of sharp repricing, sudden volatility, or forced adjustments in paper markets. Not always higher immediately, not always lower either, but almost always less stable. This is the kind of environment where price can gap unexpectedly, where stop losses don't behave as planned, and where models based on normal conditions begin to fail. This brings us to one of the most important points in this entire update: why price is lying to you right now. This is where most people get misled. They look at silver and say, price isn't doing anything crazy, nothing to worry about. That's exactly the problem. Liquidity tightens before price reacts, not after. By the time price reflects the stress, the opportunity to prepare is usually gone. Think of it this way: price is the headline. Liquidity is the plumbing. When the plumbing is working, nobody thinks about it. When the plumbing starts to fail, the headline changes fast: flooding, damage, chaos. Right now, the plumbing in the silver market is under pressure. That's why small moves feel exaggerated. That's why dips snap back faster than expected. That's why volatility feels unnatural, even when price itself doesn't look extreme. The market is telling you something, but it's doing so quietly, and quiet warnings are the ones that matter most. Loud warnings come too late. This quiet phase is where conditions are changing, even though most participants are still focused on yesterday's narratives. Now let's talk about who gets hurt first when liquidity tightens, because this is where consequences become real. When silver liquidity tightens, leveraged traders feel it first. These are participants who rely on smooth market function to manage risk. When liquidity dries up, slippage increases. Stops get skipped. Losses compound faster than expected. Short-term speculators are next. They get whipsawed as price swings become more erratic and less forgiving. Paper holders also face a different kind of risk in this environment. Not default risk, necessarily, but delay risk. Settlement delays change behavior. They create uncertainty. They encourage hoarding. They force participants to reprice risk defensively. And when enough participants do this at once, the market transitions from normal to fragile. Fragile markets don't need a big shock to break. They only need a nudge. That's what makes this phase so dangerous. Everything looks fine until suddenly it isn't. So what should you be watching next? This is the most important part of this entire update. If liquidity is tightening, the signals that matter are not the ones dominating headlines. They're the structural ones. Delivery pressure is critical. Not the stories about it, but actual settlement behavior. Are deliveries smooth, or are they becoming more strained? Bid-ask spreads matter. Widening spreads are a direct sign of stress. Reaction to bad news is another key signal. If silver stops falling on negative data, something has changed under the hood. Speed matters as well. Fast moves on low volume are a red flag. They indicate that the market lacks depth, that it can't absorb pressure the way it used to. This is not about predicting a specific price number. It's about understanding market condition. Conditions determine outcomes far more reliably than forecasts. Another important element here is psychology. Markets run on confidence. Liquidity is as much about willingness as it is about availability. When participants begin to doubt their ability to exit positions cleanly, they change behavior. Position sizes shrink. Time horizons shorten. Risk tolerance drops. All of this feeds back into liquidity, making conditions worse. This is also where correlations begin to break down. Assets that usually move together stop doing so. Technical levels lose reliability. Patterns fail. Traders blame the charts, but the real issue is structure. Liquidity stress distorts everything. It's also important to understand that this kind of environment doesn't resolve overnight. Liquidity tightening unfolds in phases. First comes subtle withdrawal, then comes instability, then comes repricing. The mistake most investors make is assuming that because phase 1 isn't dramatic, it isn't important. In reality, phase 1 is the warning. Phase 3 is the consequence. We also need to acknowledge the broader backdrop. Silver does not exist in a vacuum. Currency uncertainty, interest rate volatility, and geopolitical stress all compete for liquidity at the same time. When multiple systems demand liquidity simultaneously, something has to give. Smaller, more volatile markets like silver often feel that pressure first. This is why it's so important to stay grounded right now. This is not a call for panic. It's not a call for blind action. It's a call for awareness. Understanding that silver liquidity is tightening should change how you think about risk, leverage, and time horizon. It should encourage patience, not impulsiveness. History shows us that major market moves rarely announce themselves clearly. They develop quietly, then suddenly. Liquidity is the bridge between those two phases. Right now, that bridge is narrowing, and when bridges narrow, traffic slows, until eventually something jams. So let me leave you with this. Markets don't break when everyone is screaming. They break when liquidity quietly disappears. And right now, silver liquidity is tightening faster than most people realize. This is not a guarantee of any specific outcome, but it is a clear warning. If you found this update useful, make sure you're subscribed. I'll be watching this situation closely, and I'll update you the moment conditions escalate. Because when liquidity goes, everything changes, and it changes fast.